Hello everyone, this is Harshita Kohli from GM Financial Services. Welcome to Talking Finance. Today, let us dispel some common myths around investing in mutual funds. Mutual fund invest only in stock market. There are over 30 categories of mutual fund scheme that invest in various types of instruments, not just in stocks. There are debt mutual funds that invest in fixed income generating instruments like bonds, debentures, and corporate deposits. The schemes are usually stable and their returns are not linked to market movements. Here's the second myth. Mutual funds are only for long term. While equity-oriented mutual funds are promoted as instruments for long-term wealth creation, there are mutual funds that offer returns for a period as low as 1 day. These are called overnight funds. There are many other types of debt mutual funds that offer returns with an investment horizon of 1 month to 1 year to 3 years. Investor can invest in this based on their requirement or their risk profiling. Here's the third myth. Demat account is mandatory to invest in mutual fund. Not really. You can invest in the schemes through the website or application of any asset management company directly or through an advisor. The units will be held in an account statement form or can be easily transacted through an online or an offline mode. So here's the fourth myth. Mutual fund of a bigger AMC are safer. A common myth of senior citizens or an old investor. Do remember that the risk profile of any scheme depends on the category and the investment mandate of that scheme. A mid-cap scheme of HDFC mutual fund or a Kotak mutual fund will have the similar risk profile as both have the mandate to invest in the mid-cap stocks. Here's the fifth myth. Lower the NAV, the cheaper the mutual fund units. This is the biggest myth of all. A mutual fund appreciation has everything to do with the appreciation in the NAV value, in terms of percentage value and not in an absolute value. For example, if you invest rupees 5 lakh in any scheme with an NAV of rupees 10, and if it performs well and in the next 5 years doubles your value, then the NAV will be rising to rupees 20 and your fund value will rise to rupees 10 lakh. However, if the NAV was rupees 100 per unit, still the effect would be the same for you. The NAV would have increased to rupees 200 and your value would have increased to rupees 10 lakhs. Here comes the sixth myth. More schemes means better diversification. So let us understand further. The investment universe is defined by SEBI through categorization of mutual fund. For example, large cap category funds have to invest minimum 80% of the corpus in top 100 companies as per the market capitalization. This means all of the schemes in the large cap category will have a lot of similar stocks. However, investing in a multiple large cap funds would not necessarily lead to diversification. Ideally, investors should consider only 1 or 2 funds in a single category in their portfolio. So here's the seventh myth. Past returns should be checked before investing. As an investor, we do not inherit past returns. While they do provide visibility regarding the history of wealth creation and consistency of the mutual fund scheme, past returns do not guarantee similar or higher returns in future. While researching on mutual funds, one should consider this following aspects. First is the experience of the fund management team, consistency of the processes followed, and investment style. Last but not the least, here comes the eighth myth. You need a lot of money to start investing in mutual funds. Well, this statement is just not true. An investor can start investing into mutual funds with as low as 1,000 in a lump sum mode and rupees 100 in an SIP mode. But one should always identify the investment goals and invest the right amount to fulfill them. I hope you enjoyed this video. For more such interesting content, please follow us on social media. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.